Imagine putting away £500 a month, doing nothing else, and decades later that machine hands you roughly £108,000 a year in cash, without selling a single share. That's the dream behind the Dividend Snowball, and today we're using Legal & General, a FTSE 100 insurer yielding around 7.4%, purely to illustrate the concept. This is not a buy recommendation, it's a lesson in how reinvested dividends can compound. Here's the maths, assuming that 7.4% yield holds, and every dividend gets reinvested. After 10 years, the pot is roughly £88,000, by 20 years around £273,000, and by 30 years about £658,000. Keep going for 40 years and, on this assumed return, capital at risk, the illustrative pot reaches about £1,462,000 from total contributions of only around £240,000. So what actually is a dividend? It's a slice of a company's profit paid out to shareholders, usually every few months, and Legal & General's payout is unusually generous. Reinvesting it, sometimes called a DRIP or dividend reinvestment plan, means using that cash to automatically buy more shares, which then earn their own dividends next time round. Do that for decades, and the growth compounds on itself, like a snowball rolling downhill and picking up more snow. Before the snowball keeps rolling, here's the reality check. Legal & General's share price has moved only about 9% in 5 years, barely more than inflation some years. That's not a criticism, it's the whole lesson. Almost none of this story's return came from the price going up. Nearly all of the return in this example came from the dividend itself, paid out quarter after quarter, year after year. That's a completely different engine to a growth stock like a tech company reinvesting profits to expand. Here, the company hands cash straight back to shareholders instead. This matters because a high yield is not automatically a good sign. Yield is just the dividend divided by the share price, so if the price falls while the dividend stays the same, the yield actually looks higher, even though nothing has improved. A big number on a yield table can flatter a struggling business. So why is Legal & General's yield around 7.4%, well above the FTSE 100 average? Sometimes it simply reflects a generous, well-covered payout policy. But sometimes a market-beating yield is the market quietly pricing in doubt about whether that dividend can last. Both explanations can look identical on a spreadsheet, which brings us to risk number 1. Dividends are never guaranteed, no matter how reliable the history looks. Companies can and do cut or cancel dividends when profits fall, when regulators demand more capital, or when a crisis hits the wider economy. Insurers in particular hold huge investment portfolios, so market shocks can hit their dividend cover directly. Risk number 2 is the classic dividend trap. This is when a very high yield exists precisely because informed investors expect a cut, and they've already sold, pushing the price down and the yield up. Buying purely for the headline yield, without asking why it's so high, is one of the most common mistakes in income investing. Risk number 3 is that the share price itself can fall, and that hurts on 2 fronts at once. It erodes the value of the pot already built, and if the dividend gets cut alongside it, the future income shrinks too. Unlike a savings account, there's no floor protecting the capital in a single company's shares. Risk number 4 is the maths itself. That £1.462 million figure assumes a flat 7.4%, reinvested perfectly for 40 straight years with no cuts and no gaps. In reality, dividends rise, fall, pause, and get rebased over decades, so real-world outcomes almost certainly zigzag rather than glide smoothly upward like the chart. None of this means the dividend snowball concept is flawed. Reinvesting income really does compound over time. It means betting the entire pot on one company, however solid it looks today, concentrates every one of these risks into a single point of failure. That's the problem worth solving next. So how do we keep the snowball but lose some of the danger? The classic answer is to spread the same idea across hundreds of companies instead of one insurer, using a low-cost index fund or ETF. One dividend cut then barely dents the whole because it is diluted among many other payers. A UK equity income fund or a global tracker holds dozens or even hundreds of dividend-paying businesses at once. Some may cut their payouts in a bad year, others may raise theirs, and the blended yield tends to move far more gently than any single share. It is a rule of thumb, not a guarantee, but pooling like this is generally considered a steadier way to capture the same dividend effect. The reinvestment mechanic itself does not change at all. Dividends still land, still buy more units automatically, and those extra units still earn their own dividends the following year. The snowball keeps rolling. It is simply built from a wider base of businesses instead of resting on legal and general alone. So what has this whole exercise actually shown? Not that legal and general is a buy, but that reinvesting a high yield for decades is mathematically powerful, turning modest monthly sums into a pot that could one day generate meaningful income. The company was simply the clearest real-world number to hang that lesson on. Strip it back, and three ingredients drove every milestone we saw: time in the market, a consistent monthly contribution, and switching reinvestment on rather than taking the cash. Remove any one of those and the pot shrinks dramatically, no matter which shares or funds sit underneath it. None of this is personalized advice, and nothing here is a guarantee of what any share or fund will do over the next 40 years. Dividends can be cut, prices can fall, and assumed returns are exactly that, assumed with capital always at risk. The honest takeaway is to understand the mechanic, then research thoroughly or speak to a regulated advisor before acting on it. Picture the shape of it one more time. 10 years in, a growing pot; 20 years, something substantial; 30 years, 6 figures turning into 7; 40 years, a pot potentially throwing off 6-figure income without selling a single unit. That is the quiet power of reinvested dividends, given enough patience and enough decades to work. If this kind of long-term thinking is useful, there is plenty more where it came from on this channel, breaking down pensions, ISAs, and the maths behind everyday money decisions. Hit subscribe so the next deep dive lands in your feed, and drop a comment if there is a topic worth covering next. Thanks for watching, and we will see you in the next one.